I made my first million at 40 and my first billion at 75. Want to know what changed? I quit doing stupid things. Everybody's hunting for the secret to getting rich. The miracle stock, perfect timing. An insider tip. Here's the truth. There is no secret. There's just a checklist of dumb mistakes. Avoid them and you win. I've spent 60 years watching smart people wreck themselves. Same errors again and again, and you're making them right now. 7 mistakes that will steal decades from you. Not months, not years, decades. Most people don't figure this out until they're 60, broke, bitter, and blaming everyone else. I'm handing you the checklist today, and if you're making even 3 of these, you're already 10 years behind. Let's see which ones. This is the Munger method. No hype, no predictions. Just what works when everything else fails. Let's go. Mistake number 1. You learn from your own mistakes instead of other people's. Wrong approach. Completely wrong. Look, I'm not smart enough to make every mistake myself. I don't have that kind of time. Neither do you. So I read obsessively. Not self-help fluff, not success stories. Failure stories. I studied every major market crash, every corporate fraud, every bankruptcy. Why? Because the same patterns repeat. Same dumb decisions, same warning signs that everyone ignores. You think you're different. You think when the next bubble shows up, you'll be the genius who sells at the top? No, you won't. Not unless you study what happened to the idiots who didn't. I read about the South Sea bubble in 1720, 300 years ago, and people still fall for the same scam today. Different label, same stupidity. Tulip mania, railway mania. .com bubble, housing bubble, crypto bubble. Same pattern every single time. Mass delusion. This time is different. It's never different. I studied the Great Depression. I wasn't even alive, but I damn sure learned what not to do. I read about people who got wiped out because they borrowed money to buy stocks. Margin calls crushed them. So what did I learn? Never use leverage. Ever. If you can't afford to own it outright, you can't afford to own it. I read every biography I could find, not to feel inspired, but to catalog mistakes. Andrew Carnegie made mistakes. John D. Rockefeller made mistakes. Even Ben Franklin messed up investments. He bought into some ridiculous scheme that went bust. But I didn't have to repeat their failures because they already wrote them down. They documented what went wrong. All I had to do was pay attention. And here's what you do instead. You lose money in crypto, then act shocked, like you're the first person to get fooled by a get-rich-quick story. You buy a stock at the top, it crashes, you're stunned. But it happened in 2000, in 2008, in 1987, and 1929. The information was always there. Thousands of books, documentaries, case studies. You just didn't read them because you were too busy watching top 10 stocks to buy now. And here's the point about learning from other people's mistakes. It's not only cheaper, it's faster. I compressed 300 years of market history into a few years of reading. I learned what killed investors in the 1800s, the 1900s, every decade. I didn't have to live through every crash. I didn't have to lose my money in every bubble. I just had to read about the people who did. So here's what you do. Read one investing disaster case study per month. Just one. Read about the .com bubble. Read about Pets.com and Webvan, companies that raised billions and went to zero. Read about the 2008 financial crisis. Lehman Brothers, Bear Stearns. How did they collapse? What were the warning signs? Read about long-term capital management. Oh, this one's beautiful. A hedge fund run by Nobel Prize winners, geniuses, who built a model claiming their strategy would only fail once every 1,000 years. They blew up in 4 years. How? Why? Read it. Read about Enron. Not just they committed fraud. How did they do it? What accounting tricks did they use? Why did smart auditors miss it? Why did analysts keep recommending it all the way to bankruptcy? Read about the Tesla shorts who lost billions betting against Elon Musk. What did they misunderstand? Read about Bill Ackman losing $4 billion on Valiant Pharmaceuticals. What did he miss? Every one of those stories saves you from paying for that lesson yourself. Boring? Yes. But losing your money is even more boring. Trust me. Mistake number 2, you buy things you don't understand. This one drives me insane. I have one simple rule. If I don't understand it, I don't buy it. Period. End of story. Sounds obvious, right? Then explain to me why you bought crypto in 2021. Can you explain how blockchain works? Mining? Proof of work versus proof of stake? Why Bitcoin has value? No? Then you weren't investing. You were gambling. And now you're angry that you lost. Here's what kills me. You'll spend an hour researching a $50 toaster on Amazon, reading reviews, comparing features, checking whether it has a bagel setting. But you'll throw $10,000 into a stock because some guy on Reddit said, "Diamond hands to the moon," and posted a rocket emoji. Makes total sense. I passed on thousands of investments, massive winners, companies that went up 50x, 100x, and I slept just fine. Why? Because I didn't understand them, and I'd rather miss a winner than lose money on something I don't get. That's the trade. You can't catch every upside, but you can avoid getting wiped out by stupidity. I passed on tech stocks in the 90s. Didn't understand them. Everyone said I was an idiot. You don't understand the internet, old man. Maybe. But I also didn't lose money when they all crashed. I passed on Amazon early. It didn't click for me at the time. Jeff Bezos was losing money every quarter, and people were calling him a genius. I didn't get it. Did I miss out? Sure. Amazon went up 100,000%. Oops. Did I lose money? No. And that's the point. Here's what people refuse to accept. When you only invest in what you understand, you eliminate 90% of disasters. Will you miss a few winners? Yes. But you won't lose everything in some bubble or fraud you never saw coming. I never bought Enron, never touched WorldCom, never bought mortgage-backed securities before 2008. Why? Because I didn't understand them, or I understood enough to know they were garbage. Either way, I kept my money. Meanwhile, brilliant people, PhDs, hedge fund managers, professionals, lost billions on things they thought they understood, but didn't. They got greedy. They got complex. They wanted to look smart. So they bought complicated derivatives, structured products, leveraged instruments, and they got erased. Here's the test. Can you explain your investment to a 10-year-old? I own part of a company that sells soda. People like soda. They buy it every day. The company makes money and shares some with me. Time = 0.6s. That's Coca-Cola. Simple. Understandable. Been around since 1886. Still selling sugar water. Still making money. Now try this. I own a synthetic collateralized debt obligation that leverages proof-of-stake consensus mechanisms to yield farm governance tokens in a decentralized and autonomous organization. What the hell does that even mean? If you need 15 minutes and a whiteboard to explain your investment, you don't understand it. You're just repeating words you heard on YouTube. And here's another test. Can you explain how it makes money? Not why the price will go up. That's not investing. That's speculation. That's hoping a bigger fool buys it from you later at a higher price. How does the business generate cash? Where does the profit come from? If you can't answer that in one sentence, you're gambling. So go through everything you own right now, every stock, every fund, every crypto token, and ask one question. How does this make money? If you can't give a clear, simple answer, sell it today, right now. Because you're about to learn an expensive lesson, and I'm trying to save you from it. Mistake number 3, you're in a hurry. You want to be rich by Thursday. Not happening. Never happening. Look, I built my wealth over 60 years. Not 6 months. Not 6 years. 60 years. People ask me all the time, what's the secret to getting rich quick? There isn't one. That's the whole secret. No shortcut, no hack, No loophole, just time and compound interest. The big money isn't in buying. It isn't in selling. It isn't in timing the market or finding the next Amazon. It's in sitting, waiting, doing nothing. But you can't do nothing, can you? It drives you crazy. You see someone make 200% on a meme stock in 3 weeks and you panic. I'm missing out. Everyone's getting rich but me. I need to do something. So you start trading, day trading, swing trading, options, crypto, chasing every hot tip on Twitter, Reddit, TikTok. 5 years later, you've gone nowhere. Actually worse than nowhere, because you paid fees and taxes on every stupid trade. Meanwhile, the boring guy who bought an index fund 5 years ago and forgot about it, he's up 60, 70, 80%. He doubled his money. He's sleeping well, not checking his phone every 5 minutes, not having panic attacks every time the market drops 2%, not fighting strangers online about why his stock is going to the moon. Here's the math you don't want to hear. 20% per year doesn't sound exciting. It sounds slow, it sounds boring. But 20% per year for 60 years turns $10,000 into $500 million. That's not a typo. That's not an error. That's compound interest, the thing Einstein called the eighth wonder of the world. Not because it's flashy, because it works. But you don't want to wait 60 years. You want it now. You want to be a millionaire by 30. So you take risk, big risk, stupid risk. You use leverage, you trade options, you go all in on speculative garbage. And then what happens? You lose it all. Or you make a little money, get cocky, and lose it all on the next trade. You don't need home runs. You don't need to find the next Tesla or Bitcoin or whatever the trend is. You need to avoid strikeouts. Hit singles, get on base, don't swing at bad pitches. That's it. That's the whole game. But your ego won't let you play it that way. You want to brag at parties? I made 500% this year. You want to screenshot your portfolio gains and post them online. You don't want to say, I'm slowly compounding wealth over decades by investing in boring companies and index funds. That's not cool. That's not impressive. Nobody gives you likes for that. But it works, and your way doesn't. Here's your reality check. If you've been investing for 5 years and you're not beating a simple S&P 500 index fund, you're not an investor. You're a gambler with a losing record. The S&P averages about 10% per year over the long run, just sitting there doing nothing. No genius required, no special knowledge, no hot tips. If you're doing worse than that after all your research, all your trading, all your stress, all your subscriptions to newsletters and premium Discord groups and stock-picking services, then you'd literally be better off doing nothing. Buy the index fund, set it and forget it. Go live your life, play with your kids, learn a hobby, check back in 30 years. You'll be rich. Not exciting. Correct. And here's the brutal part. Most active traders don't beat the index. We're talking 90% of active traders underperform a basic index fund over 10 years. 90%. Those are terrible odds. You're not special. You're not the exception. You're part of the 90% losing to a robot that costs $3 a year in fees. Mistake number 4, you think diversification means owning everything. This is where Wall Street really plays you. They love telling you to diversify. Don't put all your eggs in one basket. Spread your risk. Sounds smart, right? So you do exactly what they say. You buy 50 stocks, you buy international funds, you buy bonds and REITs and commodities and crypto and gold and silver. You own everything. Congratulations, you achieve perfect diversification and you own nothing. Here's what I actually said about it. Diversification is protection against ignorance. It makes very little sense for those who know what they're doing. Read that again. Diversification is for people who don't know what they're doing. If you truly understand investing, you don't need 50 positions. You need 6, maybe 10 if you're cautious. At one point, 90% of my net worth was in one company, Berkshire Hathaway. Was that crazy? Reckless? No. I understood that business inside and out. I knew how it made money. I knew the people running it. I knew Warren for 50 years. I wasn't diversified. I was concentrated in what I knew. And it worked out pretty well. Last time I checked, I died a billionaire. Now look, I'm not telling you to put 90% of your money in one stock. Unless you're me or Warren Buffett, you probably shouldn't. But here's what nobody tells you about over-diversification. When you own 50 stocks, you basically own the whole market. That means you get market returns around 10% per year. Fine. But you can't possibly understand 50 businesses. Nobody can. You don't have time to read 50 annual reports, track 50 management teams, understand 50 industries. So you're not really investing. You're building a do-it-yourself index fund with more work, higher fees, more taxes, and probably worse returns because you'll make mistakes picking those 50 stocks. You'd be better off buying a real index fund and saving yourself the headache. Here's a smarter approach. Own 8 to 12 businesses you understand, not 50 names you grabbed from a stock screener because they had good PE ratios. Not everything because you're scared and you don't know what else to do. A concentrated portfolio of businesses you've actually researched, companies you understand, industries you follow. I said if you can identify 6 wonderful businesses in your lifetime, that's all the diversification you need. 6, not 60. 6 truly great companies you understand with durable competitive advantages, run by honest and competent people. Buy them, hold them, get rich slowly. And if you don't want to do the work, if you don't want to read annual reports, listen to earnings calls, study competition, then just own an index fund. Seriously, that's not failure. That's self-awareness. That's intelligence. Most people would be far better off owning an index fund than pretending they're stock pickers. There's no shame in that. The shame is owning 50 stocks you don't understand, underperforming the market, paying unnecessary fees and taxes, and wasting your time. That's shameful. So here's what you do. If you own more than 20 individual stocks right now, you're over-diversified. Cut it down. Keep only what you truly understand and genuinely believe in. If you can't explain in one sentence why you own it and how it makes money, sell it today. And if you end up with 5 stocks or an index fund, good. You just improved your portfolio and saved yourself years of mediocre returns. Mistake number 5, you're bleeding money on fees and taxes and you don't even notice. This one is boring. I know. Nobody wants to talk about expense ratios, tax efficiency, and fee structures. But it's costing you tens of thousands, maybe hundreds of thousands, maybe millions over a lifetime. Let me show you the math. Pay attention because this matters. Let's say you invest $10,000 per year for 30 years. Pretty normal. Scenario 1, you use a low-cost index fund. 0.04% expense ratio, basically free. You buy and hold. You don't touch it. You don't trade. At 10% annual returns, you end up with about $1,800,000. Nice, that's a real retirement. Scenario 2, you use an actively managed mutual fund. A 1% annual fee. Doesn't sound like much, right? Just 1%. One tiny percent. Same 10% returns before fees. But after fees, you get 9% per year. You end up with about $1,500,000. The difference? $300,000 gone. Vanished into your fund manager's pocket for the privilege of underperforming the index. That's not a typo. A 1% fee costs you $300,000 over 30 years. For nothing. Actually worse than nothing, because most actively managed funds don't even beat the index. So you're paying more to get less. Brilliant. And that's only expense ratios. That's just the annual fee. Now add trading commissions if you're constantly buying and selling. Add bid-ask spreads. Add capital gains taxes every time you sell something for profit. Short-term capital gains, if you held less than a year, can be taxed at 37%. Your top marginal rate? Long-term capital gains are 15% to 20%. Still a lot. Most active traders are handing over 30% to 40% of their gains to fees and taxes, and then wondering why they're not building wealth. I'm up 50% on my trades this year. Great. After taxes and fees, you're up 30%. Congratulations. You worked your butt off, stressed for 12 months, and barely beat an index fund that required zero effort. Warren and I obsessed over this for decades. We held stocks for 30, 40, 50 years to avoid capital gains taxes. Why sell? You sell, you pay taxes, and you lose 20% right off the top. Now you have to find another investment that's 20% better just to break even. That's stupid. Berkshire Hathaway doesn't even pay dividends. You know why? Because dividends are taxed immediately. The government takes its cut before you can reinvest. We'd rather keep the cash inside the company, reinvest it into more businesses, and let it compound tax-free for decades. That's how you build generational wealth. Not by handing the government a slice every year through dividends and capital gains. But what do? You trade non-stop. You sell winners too early because you're scared of losing gains. You hold losers too long because you're too stubborn to admit you were wrong. Every trade equals fees. Every short-term sale equals higher taxes. You're working against yourself. You're bleeding money and you don't even notice it. So here's what you do. Calculate how much you paid in fees and taxes last year. Seriously, do the exercise. Go to your brokerage account. Look at your 1099 tax form. Add up your capital gains taxes. Add up your trading commissions. Add up your expense ratios if you're in mutual funds or ETFs. Add it all up. If that number is more than 1% of your portfolio value, you're trading too much. You're paying too much. Stop. Switch to low-cost index funds. Stop trading. Hold for the long term. I'm serious. This might be the single most valuable advice I can give you. Minimize fees and taxes. It's not sexy, it's not exciting, but it might be worth an extra $500,000 to you over your lifetime. Pay attention. Mistake number 6, you let your emotions make your decisions. This is the big one. This is what destroys most people. This is why smart people with good intentions still end up broke. Your biggest enemy isn't the stock market. It's not the economy. It's not China, inflation, interest rates, or Jerome Powell. It's you, your emotions, your fear, your greed, your panic, your FOMO. When the market crashes, you panic and sell everything. When the market is booming, you FOMO and buy at the top. You do the exact opposite of what you're supposed to do. Buy low, sell high. Great advice. Everybody knows it. Nobody follows it. You know what people actually do? They buy high when everyone's excited and everything feels safe. They sell low when everyone's terrified and it feels like the world is ending. Every time, like clockwork. Let me give you real examples. March 2020, COVID hits. Nobody knows what's happening. The market crashes. The S&P 500 drops 34% in 1 month, the fastest crash in history. Panic everywhere. News channels running death counts 24/7. Everyone terrified. What did most people do? They sold everything. It's going to zero. This is the end. The next Great Depression. Cash is king. What did we do at Berkshire? Nothing. We sat there. Actually, we bought more. The market was on sale. Great businesses trading at huge discounts. Why would we sell? And what happened? The market fully recovered by August and hit all-time highs by the end of the year. Everyone who panicked and sold at the bottom locked in their losses permanently. Then they were too scared to buy back in, so they missed the recovery. The best buying opportunity in a decade, and they did the exact opposite of what they should have done. Then 2021 shows up. Markets booming. Everything going up. Crypto goes insane. Bitcoin hits $60,000. Dogecoin, NFTs, meme stocks, GameStop, AMC. Everyone's making money. Or it looks like they are. This time is different. New paradigm. Money printer go brrr. What did most people do? They jumped in with both feet. I'm missing out. Everyone's getting rich but me. I need in now. FOMO is a hell of a drug. What did we do at Berkshire? Nothing. Actually, we were sitting on $150 billion in cash, doing absolutely nothing. People called us idiots. Buffett and Munger are too old. They don't get it. They don't understand crypto. They don't understand memes. Boomers. We heard it all. Then what happened? 2022 hits. Market crashes. Crypto crashes. Bitcoin drops 70%. Meme stocks give back everything. NFTs become worthless JPEGs. All those diamond hands turn into paper. And the people who bought at the top in 2021, most of them are still underwater, still praying just to break even. Meanwhile, we had $150 billion in cash ready to deploy when everything got cheap again. Here's the pattern you need to understand. When you feel like you should sell, when your gut is screaming to get out, when you're checking your portfolio every hour and you can't sleep at night, that's usually when you should hold or buy. And when you feel like you must buy, when everyone around you is making money and you feel left out, when it feels like easy money and you'd be an idiot not to jump in, that's usually when you should wait or sell. Your emotions are built for short-term survival. Run from the lion, fight the enemy, don't eat poisonous berries. Great for staying alive in the jungle. Terrible for building long-term wealth. Your short-term panic instincts will destroy your long-term financial future. So here's what you do. Write down your investing rules right now. Not during the next crash, not during the next bubble. Right now, when you're calm, rational, and not emotional, write them down. I will not sell during a crash unless I truly need the money for living expenses. I will not chase hot stocks just because they're going up. I will not check my portfolio more than once a month. I will not make decisions based on fear or greed. Whatever your rules are, write them down. Print them, put them somewhere you'll see them. And when the next crash comes, and it will come, and your emotions are screaming at you to do something stupid, read your rules. Follow them, not your feelings. Your feelings are trying to kill your financial future. Mistake number 7. You quit too early. This is the killer. This is the one that destroys more wealth than all the other mistakes combined. You stop right before it works. Most people try investing for 2 years, 3 years, maybe 5. They don't get rich fast. They get frustrated. They get bored. They quit. They say, investing doesn't work. The game is rigged. Only the rich get richer. The little guy can't win. Then they go back to lottery tickets and complaining about the system. Here's what they don't understand. Wealth compounds slowly at first, very slowly, painfully slowly. For the first 10 years, it feels like nothing is happening. You invest every month. Numbers go up a little, then down, then up a little more. It's boring. It's frustrating. You look at your account after 5 years and think, that's it? After 5 years of discipline, saving, and investing, that's all I have? I get it. I understand that frustration. But here's what happens if you keep going. Year 15, year 20, year 25, year 30. Suddenly the numbers start moving fast, really fast, because you're not just earning returns on your contributions anymore. You're earning returns on your returns. You're earning returns on the returns of your returns. That's compound interest. And it's exponential, not linear. The first $100,000 takes forever. It feels impossible. You grind, you save, you invest. It takes years to hit that milestone. But the second $100,000 happens faster. The third happens even faster. By the time you get to your fifth or 600,000, they start showing up every year or two. That's the magic of compounding. But you only get it if you don't quit. I didn't make serious money until my 50s. I didn't make my first billion until my 70s. That's 30, 40, 50 years of doing the same boring things over and over. Buying good businesses, holding them, reinvesting. letting it compound, not selling during crashes, not chasing bubbles, just staying disciplined for decades. Most people don't have that kind of patience. They want results now, and when they don't get them, they quit. They try stocks for a few years. Doesn't work. Then they switch to real estate. Too slow. Then crypto. That blows up. Then options trading. They lose money. Then day trading. They lose more. They spend their whole lives jumping from strategy to strategy, never sticking with anything long enough for it to work. Well, here's the truth nobody wants to hear. The stock market has returned about 10% per year for the last 100 years. Through world wars, through the Great Depression, through recessions, crashes, bubbles, panics, everything. 10% per year on average. That means if you invest consistently and don't do anything stupid for 30 years, you will build significant wealth. Not maybe, not probably. You will. It's math, it's inevitable. But you'll be tempted to quit. You'll be tempted in year 3 when there's a crash and you're down 30% and everyone is screaming that it's the end of the world. You'll be tempted in year 7 when your buddy made 500% on some cryptocurrency and you're only up 80% and you feel like an idiot. You'll be tempted in year 12 when it feels like you're running on a treadmill going nowhere, wondering if this is even worth it. That's when most people quit. Right before the exponential phase kicks in. Right before all those years of patience start paying off big time. Don't be that person. Don't quit. You already did the hard part. You already lived through the slow years, the boring years, the years where it feels like nothing is happening. If you quit now, all of that was for nothing. But if you keep going, if you give it another 10, 20 years, you'll be in the top 5% of wealth in this country. Guaranteed. So here's my last piece of advice, and then I'm done. Pick a strategy, index funds, dividend stocks, value investing, whatever. Something boring, something proven, something that's worked for decades, and then stick with it for a minimum of 30 years. Not 3 years, not 5 years. 30. Don't quit when it's hard. Don't quit when it's boring. Don't quit when your friends are making more money doing something else. Don't switch strategies every 2 years chasing the next hot thing. Just keep going. Keep contributing. Keep reinvesting through crashes, through booms, through boredom, through FOMO, through fear. Just keep going. That's it. That's the whole game. Avoid these 7 mistakes. Be patient, be disciplined, don't quit. You won't get rich in 5 years. Probably not in 10 either. But in 30 years, you'll be wealthier than 95% of people in this country. And you'll do it without stress, without gambling, without getting lucky. Just by being patient and refusing to be stupid. Now, if you made it this far, you're serious. Most people already clicked away looking for top 5 stocks to 100x in 2024 inches or whatever garbage is trending. Good. Less competition for you. More opportunities for patient people who actually understand how this works. Hit that subscribe button if you want more of this. No hype, no hot takes, no predictions that will be wrong in 6 months. Just timeless principles that worked 50 years ago and will still work 50 years from now. That's what this channel is about. I'm out. Go do boring things that make you rich.